Welcome back to the Market Insights webinar. So glad to have you join us each week where we touch base on a certain topic. And this week, we're going to talk about clean energy. So got a lot of feedback on that, a lot of thoughts around that. So we're going to dive into that topic today. And I also want to thank everybody for taking the time to send us some questions. We got a lot of questions this week. We're going to try our best to get through them. With that, let's get started. Got to start off with a couple disclaimers. Always do that. Key disclaimers here saying, number one, we're not providing individual recommendations. Number two, we're not going to provide individual advice. Our focus for these sessions here is to provide you some good education, some good insights to the overall market with some focus in around ETFs. Now, that's not just my disclaimer because we have some guests here today, and one of our guests comes from the S&P, Standard & Poor's that is, and of course, they've got some disclaimers, and I'm going to say the exact same thing for them, not specific advice and not specific recommendations. And with that, let's get started here in the session. I got a couple people to introduce. First and foremost, I'm going to start with Tim Nash from Good Investing. Now, he focuses it on his thoughts around investing in ESG and responsible investing across the board. Myself, of course, but I'm going to move to Mackenzie Box from Global Asset Management, one of our product managers, and Tim Bursnick from the S&P itself, Standard & Poor's. And then let's get to the core topic today. But before I get to the core topic of clean energy, we always start these sessions off with some interesting tools out there. Now I'm going to highlight one that we just launched at BMO. And if you want to Google this, take a look at it. Just type in My ESG Tool. And that's a new tool we just launched to help people in their journey around environmental, social, and governance thoughts for investing, and just where you are on the journey. Are you a little early on the journey, ready there? You're a little more pragmatic on the journey. Just kind of helps you figure out where you are on that journey across the board. So take a look at it. My ESG Tool, a new one out there for you. With that, let's get into the core topic today, clean energy. I'm going to bring in Tim to start off with because, Tim, you've had some thoughts about why this has become more of a popular topic these days, and certainly some of the things we're seeing out there that drives people's attention towards this topic. Tim, you might be on mute there. And I'll give you one more sec there, Tim.
Hear me now?
Yep, there you go, Tim. Take it away.
Okay, didn't like that microphone. So thank you so much for having me. Such a pleasure to be here and for everyone who's attending. So yeah, certainly clean energy has been a very hot topic, pun intended, over the last 6 months to a year. You know, really, this is a space that I've been tracking for over a decade now. But really the conversation has shifted just so much due to climate change that I think for a long time, climate change was something that we sort of viewed as off in the future, and that now we are starting to see the impacts of climate change right away, that it's here, it's happening, and likely it's only going to be getting worse. And so seeing a lot of momentum around from investors, from companies. So many corporations are now launching their climate change plans. Obviously on the government side, I think we're going to talk a little bit about that, and as well even central banks. So the Bank of Canada here in Canada, in the US, you've got the Federal Reserve, that everyone is now starting to recognize climate change as a systemic risk to the global economy. So there are a couple different ways we look at it. There's both the physical risks. So these are going to be things like floods and fires, and you know, storms get worse, things like that. But also the transition risks, and this is the financial risks coming from the transition sort of away from a fossil fuel, more carbon intensive economy towards renewable energy and clean technologies, this sort of low carbon economy. And so certainly a lot of investors are trying to get ahead of the curve, which is why I assume people are on this webinar today, want to learn a little bit more about how to actually invest in the solutions.
Thanks, Tim. Let me stay with you for a bit because, you know, certainly hearing about the news, environmental, but, you know, why do you think it's becoming more of a popular topic now from the news, and maybe the transition we're seeing with inside different structures of the market itself with feeding of energy?
Yeah, I mean, I think people just care about it more and more. Sadly, for a long time, there was, I would say, a bit of a sort of a negative bias on these things where, a lot of people just either didn't believe it was happening or didn't quite understand the science behind climate change, and a lot of skepticism there. Now it's really becoming undeniable that the climate is changing. And really what's happened is that for a long time, CO2 emissions were viewed as something called an externality. They were sort of viewed as external to the profit maximizing equation. Whereas now what we're seeing is that companies around the world are really starting to internalize that those CO2 emissions. And so you can see here, BP, this is not a tree hugging company by any stretch of the imagination here. This is one of certainly the oil majors. And you can see that even what they're saying now in their outlook is that their use of coal and oil and other fossil fuels is going to decline. And you can just see that orange renewables chart is just really starting to take off. So there are a number of reasons, certainly on the economic front with the cost structure of renewables versus fossil fuels and the competition there. But I would say it's a bigger sort of like psychological shift that's happening right now. Certainly we're seeing a lot of younger investors who care more about this issue. They now have income to be able to invest. That this huge intergenerational transfer of wealth is happening. And I think a lot of these investors are seeing that kind of the writing is on the wall for the decline of fossil fuels, and are really looking to invest in the solutions that I think have much higher growth prospects.
Thanks for that. Phil, let me bring you in on this because, S&P Dow Jones, the index providers, you certainly have studied this in a number of ways. And when we talk about clean energy, it's interesting to take a look that it's not just one type of clean energy. There seems to be a growth across the board in clean energy alternatives or all energy alternatives. Talk to us about that.
Hi, Kevin. Sure. So against the backdrop of the previous slide here, really what we like to look at is, where is the growth coming from? Seeing that renewable energy will be the dominant producer come 2035, mid-2000s, where is this actually going to be coming from? So what we see is the generation will actually come from a diversified mix, mostly led by solar, wind, and hydro. So if you look at the 2030, 2040, 2050, you can see a few interesting things here. Currently dominated by hydro, but over the next 20, 30, 40 years, you can see it'll be pretty well split between solar, wind, and hydro. So when we look at this, as far as expectations go, focusing on just one area of the renewable energy space would leave out significant exposure to not only the growth of the overall industry over the next 20 to 40 years, but also what will actually be generating come 2050.
Well, it's good to see where we think, or what the firm, of course, is projecting where clean energy. The other thing you've looked at too is firm Dow Jones and Indices, the S&P Dow Jones Indices, is you've looked at the landscape of clean energy, and that being more of the global aspects, what's going on and the transformation there too. Talk to us about that a bit too, please.
Sure. So what we see, this is based on government studies, is this is clearly a global phenomenon. You see the Paris Agreement that was signed. You saw President Joe Biden coming back and signing the U.S. up for that in the first few hours of his first day. This is a clear global phenomenon, and actually the projections show that the growth in consumption through 2050, that actual growth will mainly be coming from non-OECD countries, primarily in Asia. So when we look at this and how to capture the clean energy companies, clean energy growth that you saw in the previous slide, you really need to put on a global hat to really capture that growth. And one thing here, the study is from 2019, 2020. So with what I mentioned before, with what you could say the quote unquote blue wave energy policies that are expected to come, this could mean even higher growth in the United States as well.
Thanks for that, Phil. Tim, let me bring you in on, clean energy itself, or more specifically, this messaging we're hearing about, net zero emissions. And you had some thoughts in regards where it's China and US, and the bigger picture out there. So give us your thought about this carbon neutral concept coming through.
Yeah, so it's been really interesting over the last couple of years. There, basically every major company, all the large cap companies, are coming up with some sort of long-term ambitious goal. And the language on this becomes really tricky because it forces us to sort through this idea of net zero versus carbon neutral. I think IKEA came out saying that they want to have negative carbon emissions, so it's really sort of a range of options. And certainly it is a little bit muddy still about exactly what that means and exactly how it's going to work. Oftentimes what it does mean with the net zero, it does give this wiggle room for companies to be able to purchase carbon credits or to be able to invest in technologies that are actually designed to capture carbon and then store it underground. So this doesn't mean that they're not going to be emitting anything, that all that all emissions are going to disappear. But instead what it means is this sort of new form of accounting, that it's certainly a commitment to be able to measure and track and disclose what their carbon emissions are. And not only the emissions that they're putting out into the world, but also in terms of, if they're able to capture those emissions, or if they're able to, through technologies, reduce emissions elsewhere. Right, so really, it's lots of announcements here. Really, I think it's going to be interesting over the next few years as companies have to start reporting on their progress towards these long-term goals. Are they actually moving the needle here, or is it a bit more of a PR exercise? I think the jury's still out there, but certainly will be really interesting there. We saw the graph before about the increased energy demand coming from China, from Asia. Certainly China is the biggest part of that. And really their approach has been a sort of all of the above energy source strategy, where certainly they are still building coal plants and they are still using a lot of fossil fuels. But they've also recognized this major transition taking place, and they're becoming absolute leaders, specifically in the electric vehicle market, EVs, and with solars. We've seen huge investments by the Chinese government into solar power. So it's going to be really interesting to watch China. Really, there's no doubt that the EU, the European Union, is leading the way on this, no doubt. Because of the change in the political climate in the US, we're now expecting North America to be on board in a way that we weren't really before. And then really, I think the eyes of the world are going to be on China, because this is a global issue. It really only works if we're all here together. And really, we need this global movement in this direction. And it's also, I expect it to bring up this conversation around carbon tariffs, that really if some countries are moving ahead faster on this and other countries are sort of lagging behind, it's sort of very logical. I would really expect there to be these sort of carbon border adjustments or carbon tariffs, knowing that really that's going to kind of force the hand, and that we do expect the whole world to be moving on this kind of in the same direction. So, right now I would say we're still in sort of a lot of the talk mode, that there's still a lot of talking going on. We're still figuring out these terms. We're kind of making these big audacious announcements without necessarily a huge amount of knowledge about how we're actually going to be achieving those goals. But over the next few years, it's just going to be so exciting to be able to watch, and with the data in place to be able to track whether countries are moving in the right directions and which ones are leading the way.
Thanks, Tim. Let me stay with you a bit more, because you mentioned US. And one of the things we're of course hearing about in the news is this greener grid and the goals coming out of the new administration. Maybe you can talk quickly about that too.
Yeah, totally. So, the pendulum has definitely swung. That, really for the last 4 years, we did have an administration that was, basically borderline in denial about climate change, really moving things backwards, and certainly, not a huge ally in the fight against climate change. But now with the Democrats, especially the fact that they've taken control of the House and the Senate, really expecting this to be a major policy platform over the next 4 years. So certainly we've got this $2 trillion, this infrastructure plan. We know about Joe Biden that it's going to be about jobs, American jobs. So, expecting a lot of infrastructure around things like public transit, maybe a rail network, renewable energy, smart grids, like a lot of those more job intensive sort of green sectors, I expect to get a real boost. Certainly with the Paris Agreement, it's going to be interesting to see. That is a longer term issue, but the US is now sort of back at the table when it comes to these global conversations. And really without the US for the last 4 years, when the US has been absent, really not much happened. That it was really this kind of acknowledgement that we do need the US to be a part of this, and that now that they're playing a leading role, it's going to be really interesting to see what kind of global initiatives we can get towards. And what's not on this list that I think deserves a little bit of a shout out is the work that's being done by the central banks. So now that we've got Janet Yellen as the Treasury Secretary, she's been very outspoken about recognizing climate change as a systemic risk to the global economy, but obviously the US economy is a huge part of that. So I am expecting the US Federal Reserve to be joining some of these global initiatives that the central banks have been pushing forward. The Bank of Canada has been very, very clear about the risk that climate change poses to the Canadian economy, and really planning to take steps to ensure that we are protecting ourselves against that systemic risk. So I just think we're going to start to see movement across the board. I think we started to see a little taste of that sort of in the first 100 days of the Biden presidency. But really, I'm seeing that this is, I think, going to be a major policy plank over the next 4 years.
Thanks for that, Tim. One thing that we came across beyond the more the news around it, something from the Wall Street Journal, they took a look, and this is kind of a little bit surprising for me, was they took a look at the cost structure changes inside producing electricity, but now coming from the more cleaner side of the ledger, I guess, when you do the balance sheet of CO2. Tim, talk to us about this, because you had some thoughts about why that's happening now.
Yeah, it's, and I've been following this stuff for over a decade now. So, if we look back to 2010, the number of times I would bring up renewable energy and would just get dismissed, saying, the subsidies, and, it's not competitive, and, the sort of the economics of the whole situation, and that was really sort of the major talking point for why we shouldn't transition to a greener economy. And that certainly, we did see that in Ontario with some of the early contracts for wind projects, for solar projects. They did pay these really, really high rates, in order to really kind of kickstart that economy. But now what we're seeing is the economies of scale. And nowhere have we seen it greater than with solar, that the price per megawatt hour of solar has just fallen so dramatically. Part of this is going to be through innovation and just the technology being improved. Part of it is through economies of scale, right? And the global supply chains just get bigger and stronger. Really that cost per unit is just going to keep going down. And I expect this to continue to fall, specifically around offshore wind. We're seeing some major price declines there, which is fantastic. And that solar just keeps getting cheaper and cheaper and cheaper and cheaper. Meanwhile, when you look at fossil fuels, the cost structure there, they're so well established. We know what it's going to cost, in terms of coal and natural gas, and that those costs are going to remain about where they are. If we start to factor in a price on carbon, so a carbon tax or cap and trade systems, and that's actually going to push up the cost of those fossil fuel sources of electricity, whereas the renewables, really are competitive on their own now, that in many parts of the world, solar is cheaper than coal and natural gas. Now, what's not part of this chart is energy storage. that obviously coal and natural gas, these are considered sort of base load power. When it comes to solar and wind, they are going to be intermittent. They're not going to be available sort of on demand, which is why we are going to need to have some of these grid scale storage backups. These could be battery farms. A lot of them we're seeing actually using our natural resources. So, you know, in Goderich, Ontario, there's an old salt cave that they're using as a giant battery. You know, under Lake Ontario, here in Toronto, they've got these giant bags that they inflate and then let the pressure of the lake deflate them to spin the turbine. Really, really cool, innovative technologies on the energy storage side as well. And that really, that's what we're kind of sort of waiting for, is that as soon as we have solar or wind plus storage that is cheaper than coal and natural gas, you know, to me, that's really the holy grail when, you know, this stuff is just going to take off, that the economics at that point reach a tipping point where it just becomes so much cheaper to be able to build out these renewable energy sources than it is to have this sort of legacy fossil fuel plants.
Tim, I appreciate the additional insight too. That's good. I had not known about the bags underneath the Lake Ontario. I have to read up on that myself. Let me bring in Phil for a second. Now, Phil, you certainly take a look at it from S&P perspective, not only the clean energy aspect, but traditional energy. And you can talk about the evolution of companies' business models, you can, please.
Sure. So yeah, this is really against the backdrop of what Tim was talking about, the evolution of the cost just driving down, economies of scale of these companies, the cost just enable these companies to become much more competitive in the marketplace, right? And in addition to the additional demand that you see, government policies. So when we look at these companies from a profitability standpoint, what's interesting here is you go back 10 years, we see here the S&P Global Clean Energy Index as a whole, so an aggregate of all the companies, the index level profitability based on return on equity was actually negative, usually around negative 10% or so. But you can see as you go through time, as the industry is maturing, as those costs are driving down, as these companies are getting bigger, economies of scale, it actually became positive in the mid 2010s. And if you look at to date, so end of last year, where does it stand? The ROE was high single digits, around 8-9%. And if you compare that to a broad-based energy sector index, such as the Global BMI Energy Index, it actually has a higher profitability than the classical energy sector, which is really something interesting to point out. If you look at the future, on the right-hand side here, what we're really looking at is, what is the estimated growth on earnings per share of these types of companies, and again compared to the broad energy sector or just a broad equity index benchmark. You can see the estimated 3 to 5 year growth is in the mid 20%, which is quite high, and especially if you compare that to the classical energy sector index. So it's these companies are kind of moving out of that somewhat speculative state that many kind of considered 5-10 years ago. It's actually producing a profit.
It's interesting to see the transformation. It is a good discussion. I appreciate for that. Mackenzie, bring you in here. Talk to us about what we're seeing, of course, in the ETF perspective, because this is now cascading into ETFs too, where people are looking, trying to implement this thesis.
Yeah, for sure. And thanks, Kevin. And kind of just building off everything what Tim and Phil had alluded to is we're seeing huge growth in the clean energy ETF sector. I think, with all of headlines and all the stimulus and everything that's kind of being transformative to the economy, we're seeing a huge shift and a huge growth for clean energy ETFs. And when we look at ESG focused equities in general, they posted 75 billion in net creations in 2020, which was approximately 23% of all equity ETF share creations during the year. And then more particularly, and if you look at the ESG category of non-fossil fuel energy strategies, that also took off with just over 10.6 billion in new money in 2020. So we're seeing that accelerate further this year. And we've seen an additional 6 billion in creations in the first 2 weeks in January alone. So this is all in the US, but we're seeing this transform as, investors are looking to, align. They see the growth of this industry as well from an institutional side too. And if we look at, the well-known index, of course, we have S&P on the call today, the Global Clean Energy Index, which both our new ETF ZClean and iClean track, they're at over, I think, just within that index, there's over almost 14 billion in AUM. And now that's from various products, but you can see that the interest in this segment is really growing.
Well, that's perfect transition there, Mackenzie, because having the S&P online, I'm going to ask you two things. Number one, Phil, why is it so popular as an index? And then second of all, maybe give us some of the structure. And what I'm probably going to do is skip past this slide and just go straight to this slide there, Phil, as your backdrop to talk about the index itself and maybe why people are looking at this index and the diversity of it.
Sure. So I think there's a few reasons why we've seen the popularity of this index spike up. One, it's been live since 2007, so February 2007. So that's really important if you think of point in time data, having that track record there. But if you also kind of go back to what I was saying before, this really highlights some of the benefits potentially of this index. One being it has a global exposure. So you can see on the top left here, it has exposure to 16 plus countries. Even though it's a 30 stock index, it's well diversified globally, so you're getting that global exposure. But also you're getting what we kind of say is multi-industry exposure as well. So on the bottom here, you have a few pyramids that kind of give the breakout of the different types of companies that are actually included. So if you reference the sector weights on the left, you can see that this is clearly not your classical energy play here, the old oil and gas companies. There's very, very small energy exposure. So most of the exposure is actually coming from utilities, but you see heavy exposure in industrials and information technology. So if you look at that and go, well, what types of companies are actually included? Well, we're actually looking for clean energy producers, so on the production side, but we're also looking for companies that are involved in the technology and equipment space as well. And you can see we actually have listed some types of energy that we're actually looking for. So biomass and fuel, geothermal, solar, wind, hydro, ethanol, fuel alcohol, photocells. So it's a very not only diversified regional play, but it's also diversified business play. And one more thing I like to mention is to capture this, you really need to go, a step further than just looking at a way to classify these companies. So what we do at S&P is, we have people really looking at business descriptions of companies, so company by company, looking at what do the companies actually say about their businesses, what are their objectives in their businesses in the documents, but also look at revenue reported by segment. So you really have to drill down deep there to find these types of companies, and again, that enables you to go cross sectors to get that broad exposure.
Thanks for that. Good background of what's going on, the thoughts that you have in construction of the index. Now, we're certainly seeing some very much a growth in the market movements of the index. And what I like about this chart that was put together, which is kind of the background of the transformation between one index and another index. Phil, maybe give a quick little comment on this before we transition to the next slide.
Sure. So yeah, this is just going back 10 years, growth of $10,000, 10,000 units back 10 years of the Global Clean Energy Index to Global 1200 Energy Index. So you can see just the dispersion, not only going back to early 2010s when you could see, like I referenced before, these companies weren't really profitable. It was a little bit more speculative as far as, were these viable businesses, were there actual demand? But if you shift again all the way to the right, this really lines up with the recent demand, the Paris Agreement, the administration's changing, the policies that are put in place, not just the US, but also globally. You can see how the performance has really spiked up in this index, performing over 140% as of December 31st, 2020, compared to an actual negative return for the broad energy index.
Yeah, you've certainly seen a transformation. Good, interesting chart to look at. Tim, now you started talking initially about CO2, but here's a conversation we may want to get into: clean energy versus traditional energy and CO2 comparisons. Can you give us some quick thoughts about that too?
Yeah, totally. So, obviously the economic imperative is here. I think a lot of investors are looking to shift in their assets and to take advantage of this broader economic trend. But there is also sort of an ethical component to it as well. And that a lot of investors are looking to reduce the carbon footprint of their portfolio. A lot of people are trying to, fly less and, ride their bike and, eat less meat, and all those things are wonderful. But for a lot of people, the biggest source of their carbon footprint is actually their investment portfolio. So, really interesting here, to be able to see, again, comparing it to the global energy sector, so which would be sort of fossil fuels. Obviously, the clean energy index is going to have a way, way lower carbon footprint. There are a few different ways of measuring it, but that sort of carbon to revenue or that weighted average carbon intensity, really you can see it's almost about half of what we've got. This is going to be fairly high compared to broader stock benchmarks. Like if you're just looking at a global equity, this certainly isn't going to be the lowest carbon option available. And I think that, part of it is understanding that the transition isn't going to happen overnight. So a lot of the companies that are in here, especially if they're utilities, although they derive the majority of their revenues from clean technologies, you might still get some companies in here that have natural gas or cogen facilities. These are usually sort of lower carbon or more efficient power plants, but this isn't going to be like a pure play 100% renewable energy only. So you can see that there is still, a carbon footprint to this portfolio, but certainly looking at it from an energy perspective, that really what we're doing is we're reducing our carbon footprint, lowering our exposure to, an increasing carbon tax. And then really at the bottom there, you can see that fossil fuel reserve emissions, that these are the reserves, and that when you look at the traditional energy space, there's all this coal and oil and natural gas that's still underground. And, a lot of people are saying that that might end up staying underground. If we're serious about climate change, that those assets might actually get stranded. And they aren't going to be able to dig that up and sell it on the market. Whereas with this clean energy index, obviously there are no fossil fuel reserves here whatsoever. So it really reduces our risk to those quote unquote stranded assets.
Interesting point. Thanks for bringing that up, and thanks for the comparison too. Hey, Mackenzie, I'm just going to skip past those, Mackenzie, and dive into this. Let's say people are looking at different ways of getting into this trade. What are the different ways of getting access into this trade through ETFs?
Sure, thanks, Kevin. And I think there, like I had mentioned earlier, there's been a lot of growth. We've seen more and more ETFs come to market, and I think as we look forward, we'll even start to see more providers come out with clean energy solutions. So first off, there is, of course, BMO's Z Clean, which we just recently launched a few weeks ago. Of course, tracking the well-known S&P Global Clean Energy Index. That's 35 basis points management fee. So this is the same index as the well-known iClean in the States. So just keep in mind, though, if you are looking at this, the iClean is US listed. It's obviously a huge powerhouse ETF with almost 7 billion in AUM, and it's 45 basis points. And then as well, Harvest in Canada also launched a clean energy ETF a few weeks back as well, and that's at 40 basis points management fee.
Thanks for that, Mackenzie. And staying on top of that thought process too, beyond screening for securities, one thing that maybe highlight is the advocacy too, that is maybe a consideration for people out there too.
Yeah, sure. And I think when you go beyond that, I think looking at advocacy is really important, and looking when you're finding an investment to make sure you're partnering with a firm or provider that is kind of taking that a next step further in terms of their voting. So here we kind of just gave a snapshot of the industry and how everyone votes. And, it's important to look at, how you're voting against management and taking an active decision in that. So at BMO, we're very active in that. And, more often than not, we have voted against management in order to, voice our thoughts and our values and whatnot. So that is something that we take great pride in. And I think that's just something you want to keep in mind when you are looking at your providers and aligning, where your values are.
Help the good become great. Now let's shift gears. Let's jump into a few questions. I won't have much time to go through questions given the time frame wise, but I want to start off with one for you, Tim. And oops, that's my finger just jumping there. Individual has a daughter looking more green out there. That individual does still in the investing for there. So just kind of thinking of where to start for investing for somebody who's looking to get into this space.
Yeah, I get this question all the time. People, certainly this is a generational issue, I think. So, what you would want to start with is something really, really simple. Basically, it would be a basic portfolio, nice mix of both stocks and bonds. And then the way I split it up is between what I call sort of doing less evil stocks versus doing more good stocks. So most of the portfolio, you are going to want that broad diversification by geography, by sector. So looking at some of these ESG focused ETFs, I know that BMO has a great lineup of ESG leader ETFs that can really serve as kind of like the core part of a nice diversified portfolio. But then really, carving out part of the portfolio, I certainly wouldn't suggest she invest all of her money in one of these clean energy ETFs, but being deliberate and maybe carving out 10%, 15%, probably at most about 20% for these sort of thematic investments that I call are doing more good. We're really going out of our way to invest in companies that are instead of getting the broad diversification and getting rid of the nasty stuff, really focusing part of the portfolio on things that are really directly aligned with those green values.
Thanks for that, Tim. I'm going to skip past this one, given time. This is an easy one, and I really appreciate this question because it helps drive direction. A lot of reference around ESG funds. Can we have a webinar on that? Let me answer that one and say, yes, it'll come up soon. So stay tuned. We'll have a webinar dedicated towards ESG. And Tim, hopefully I can get you back for that.
Oh, I'm always happy to be here. Spend some time with you, Kev.
Perfect. Mackenzie, there was a launch of BMO ETFs not too long ago. Some big themes out there. Individuals looking for our tickers. So if we can just share the tickers.
Yeah, sure. So we have ZGen, which is our genomic innovation ETF, which gives you kind of that exposure to DNA sequencing, biocomputing, all that kind of stuff. We have ZFin, which is our fintech ETF, which provides exposure to digital and mobile payments, blockchain technologies, peer-to-peer transactions. We have ZINT, which is our Internet Innovation ETF, which again is providing exposure to cloud computing, Internet of Things, payments, e-commerce, and social media. We also have our ZAUT, which is our Autonomous Tech and Industrial Innovation ETF, which really provides exposure to that autonomous vehicles, robotics, automation, machine learning, 3D printing, and energy storage, for example. And then if you're looking for an all-in-one solution, we also have ZINN, Z-I-N-N, which gives you exposure to all four of those themes in a single ETF.
Thanks for that, Mackenzie. And I'll quickly highlight too, the topic for next week is going to be around innovations in ETFs. We'll take a look at the perspective of at least 10 years of what's happened in the ETF industry, but we'll also talk on a little bit of those new innovative ETFs themselves. So before I go, I want to take the time and say thank you to Tim, to Phil, and Mackenzie for joining us today. Thank you for your thoughts in regards towards clean energy. Very insightful across the board. We'll be back next week at 1 o'clock, February 19th. And again, talking about innovations in ETFs. Between now and then, have yourself a good weekend, a long weekend that is too, for that matter, here in Ontario. Cheers. Talk to you soon.